Hey, welcome back, folks. The Ray Lucia Show. There's a song that Mr. Pastula will remember. Hello there, Gino.
I remember them all.
Crosby, Stills, Nash.
Yes.
That was, I think, without Young. Yeah. Welcome to the program. It's good to have you here.
I wouldn't have known whether it was with or without Young.
Hey, listen, I know you got stuck in traffic. You're a little bit nervous today.
Yes, I am.
Yeah, have you had your coffee? Have you?
Yeah.
Okay, so I wanted to talk to you about something that I don't know if you heard me discuss, tax diversification. But you're one of the kingpins of tax diversification because you use insurance products that come with some tax advantages that aren't found in many other types of products. So because you were here late today, I'll give you a quick refresher of the things I was just talking about.
I am Mr. Diversification.
You are Mr. Diversification.
Yes, okay.
So what I was talking about is, individuals that, in particular those whose taxable income, married couples, is under, say, $75,000. Now that means after you write off your mortgage, interest, and property taxes and all that stuff, you're in the marginal income tax bracket of 15%. And for a lot of people that have a bunch of money stashed away in 401ks and all that, if you follow the general mantra that is promulgated by a lot of the financial press, that you should spend from your taxable accounts, like your brokerage accounts, first, then tap into your pre-tax accounts second, then tap into your tax-free accounts third. While that may keep you in a low tax bracket today, it may mean a significantly higher tax bracket sometime in the future. You don't know if you have a spouse that dies and all of a sudden you're a single taxpayer. Your mortgage interest could go away. You could downsize and rent. A lot of different things could cause your tax rates to go up in the future. So I have always been in the camp that tax diversification may in fact be as important as product diversification and asset allocation. You're a CFP, what say you?
Well, I think if you don't use insurance products like annuities and insurance contracts in your portfolio, what you say is exactly right, because you have to pay attention to all the other intricacies of those relationships in order to minimize your tax. My approach is that if you have a choice of non-taxed, partially taxed, and taxed, then what you do is, first of all, taking one step down from where you are, you basically do whatever makes sense each year. In other words, you don't set something up with a intention in advance that, okay, I'm going to take so much of my money this year in non-taxed and versus taxed or whatever. You take it as it goes to keep your rate as low as you possibly can. Now, in most cases, that in that environment, what you said is exactly the way you'd end up doing it.
Yeah, but you have a good point, because I know there's a good friend of mine very close to you that had a big capital gain last year. So all of a sudden, you got Medicare tax liabilities and all this other stuff.
Yes, he did.
So in that particular example, you may choose to take either nothing, or if you were going to take any money, you'd want to take it from a tax-free environment so as to not exacerbate an already humongous tax.
Or cheat.
Or no, you don't want to cheat.
No, okay. That's my wife said. What are you going to do?
You agree with that,
However, if you incorporate, for example, an annuity and hopefully you've built up a portfolio that is not just all qualified money,
pre-tax money.
It just I see that all the time, and it just kills me to watch people because they have no options at that point in time.
That's true.
And I just encourage people. I don't care whether you're giving up a tax deduction or not. If that's the only thing that motivates you to accumulate money for retirement, you gotta get counseling, because
you're going to pay a dear price later. As I said, married couples, sooner or later, one person or the other dies. Sooner or later, the mortgage goes away, and then if you take a look at the difference in your tax bracket, single paying taxpayer versus married taxpayer, when you have mortgage and property taxes, the numbers are pretty staggering.
Yeah, and they ain't going down.
Probably not. I don't think they will. I know that when you look at things like Social Security and so forth, we're going to have to pay for that somehow. It's either going to be benefit cuts or higher tax rates.
Yeah, well, and I don't see the benefits cuts
well,
coming.
it's hard because the gray population are voters, and so they're not going to want to cut benefits to guys like you and me.
In any event, for example, if part of your portfolio that you're using to provide retirement income is in a non-qualified annuity, for example, first of all, you can get a much higher guaranteed income return, rate of return on your income that way, so you don't use as much of it for each dollar of spendable income that you get. And secondly, the bulk of it is without tax.
Because of the exclusion
allowance.
Yeah.
Roughly about anywhere from 65 to 80% of the income that you're going to get there is going to be tax-free. So when you put that, and now you've accomplished two things. You know you're going to get the Social Security. You know you're going to get the pension if you have one. And then you know you're going to get the income from the annuity. You add that up, and in many cases, that may be sufficient. And all you would take from the rest of your assets would be money that you have a choice of whether or not to take. Am I going to go on a vacation this year? Am I going to buy a new car? What am I going to do there? And then it's much easier to do what you're talking about, which is to, okay, now let's just see, should I be taking it from a taxable account or a non-taxable account, depending on how much you want to worry about that.
Well, and what you said earlier is true. Obviously, if you have multiple accounts, each year you can take a look at your tax situation and make a decision as to how you take the money out and from where you take the money out. And you'd be surprised what kind of impact that has long-term on your taxes.
There's a new thing, and you can tell me the name of it because I keep forgetting, but it's the annuity that the government now lets you put. QLAC, yes, thank you very much.
Qualified Lifetime Annuity Contract.
Right. Now, let's say you have $750,000 sitting in your IRA. Now, clearly, you don't need to have all of that liquid. You don't need to have all that ready to take at a moment's notice. You can take up to a quarter of that, or $125,000 max, and you can put it in a qualified lifetime annuity contract, which basically says the insurance company is going to take it, hold it, and they're going to start you with income at 10 or 15 years from now, which represents a very competitive rate of return, and that money that you've put in there is taken out of your required minimum distributions. So you can save maybe, I don't know, $600, $800, $1,000 a year by just simply moving that money that you're not going to take currently anyway. So there's a bunch of good stuff there.
The government supported it.
All insurance-based.
It is all insurance-based. And it's actually something that every retiree and pre-retiree should have in the mix of things that they talk to their financial advisor about. Okay, when we come back, the case for buying long-term care insurance, we'll ask Gene Pastula, certified financial planner, if he buys what Ray Martin was talking about on the Money Watch.
Totally. I don't even know what he said.
Gene Pastula, CFP, my co-host for the next segment. Stick around. You never know what Gene is going to say. 844-RAY Show if you want to talk. We'll be back. Don't go away. A typical long-term care insurance policy, by the way, at age 50 runs $900 a year. If you wait until you're 79, when you're more likely to need it, it's $6,000 per year. Welcome back to the Ray Lucia Show. We talk about very important financial issues each week with my pal, certified financial planner, Gene Pastula. Gino, I know you've said this before, but according to the Department of Health and Human Services, 70% of folks turning age 65 can expect to use some form of long-term care during the rest of their lives. That's pretty serious stuff, especially for women who outlive men by 5 years. You invented a solution for those people that don't want to spend $6,000 a year in premiums and don't want to trust you, me, an insurance company. So you've offered a money-back guarantee on top of that. Let's talk linked benefits, my friend.
Yeah, because all those insurance companies are just, they're going to rip you off, but at least you get your money back. No, I'm kidding. Yeah, you know, it's interesting. If you had a 70% chance of getting paid on a lottery ticket,
Yeah,
would you buy the lottery ticket?
of course I would.
So what is it with the people out there that are, that have a 70% chance of needing convalescent care at some point in time, yet just do whatever they can to avoid buying insurance for it?
Well, my suspicion is they think the government is going to take care of them, and that's a fallacy.
All you do is watch the news and realize that that's not happening. Okay, well, at any rate, what we've done is we've kind of changed it. That you have the policies that, like he's referring to in that article, that cost $900 when you're young and $6,000 when you're old, if you can even get it, qualify for it. But instead of that, if that's an insurance policy, you either use it or you lose the money, et cetera. And that's what keeps people from, they can't even visualize the fact that they'll need care. And I understand that. So the other way is to do what is like an investment, quite frankly. And instead of buying a long-term care policy that it doesn't pay if you don't need the benefits and the company keeps the money, what if we bought a life insurance policy specially designed so that the insured can actually tap the benefits for if he needs it for long-term care before he dies. In other words,
meaning the death benefit.
The death benefit, correct. And so here's the idea of life insurance is put a little bit of money in so that somebody's going to get a whole big bunch of money when you pass away. But if you can get that whole big bunch of money for yourself, the purpose of the insurance now becomes not so much that you need it for your heirs so that they can continue on after you, but now it becomes you're buying it so that you can use that money if you need it for long-term care. But if you don't, all of it or any part that you don't use will go to your heirs. And when you look at it from that standpoint, it becomes an investment in your portfolio. And depending on how you purchase it, the money that you put in, if you move money, for example, which is the type of thing that we do most often, which is to move a large lump sum from, say, a bank account earning zip, taxable, into a life insurance policy all at one time, let's say $100,000. Instead of getting the 0.25% or 0.5% on it that you're getting in a bank, you'll get like 3 or 4% of it on it in the insurance company, and they use that additional, and that's tax-free incidentally, and then they use that additional interest to actually pay for providing these large lump sums that are available for long-term care.
Yeah, so basically it's virtually a way to have the cost mitigated by a higher earnings rate on an insurance policy. So the bottom line is you still have your $100,000. You still have access to it. You can still use that money if need be, but you turn the $100,000 into $200,000 or $250,000 or $180,000 of a death benefit that can be tapped into early before you die so that you can use it on long-term care, which 70% of us will need. Now, it gets better than that, though, does it not?
Yeah, in some cases, with some products, it depends on the product. And of course, we use them all. I mean, we have them all available, and we pick and choose the carrier and the product that it most fits the needs of a particular client. And that's pretty important, because we're talking about this now more, not only from a standpoint of needing long-term care and doing the job there, but also, it's part of the investment portfolio and that intention that you have. But that we can add riders to that contract so that it's like double indemnity in a life insurance, straight life insurance policy. You have this much if you die of natural causes or illness or what have you, and you have twice that much if you die of an accident. Well, in the case of the long-term care configuration, you have this certain amount of the death benefit that you draw down on first. But if you used all of that, then these riders kick in and they'll double or triple that amount. So $100,000 might turn into $150,000 if you die, or turn into $450,000 potentially if you need long-term care long enough to use all that up.
So here's what I like about that is the fact that, and I report on this, Gene, as you know, every day, how people are living longer, they're living healthier, and individuals, because of modern health care, are able to stay alive longer, but in many instances do need care or help. So the fact is, if you have Alzheimer's, for example, Alzheimer's could last for 6, 7, 8 years or longer at a pretty substantial cost. So what you're saying is, if your $100,000 turned into a $200,000 death benefit, and you use that up in the first 2 or 3 years, there'd be another $250,000 that you could tap into in years 4, 5, 6, 7, 8, right?
Correct. So, and in some cases, there's one carrier and a product that basically has no cap on it, so it's unlimited. And we use that for couples a lot of times. So you put your money into that, and you set that up. And what it says is that as long as either one of you shall live, if either one or both of you, even at the same time, need long-term care, the benefit that this thing will generate will go on until you're both passed away.
Now that's new. That's news to me. So is that something new?
No.
Okay. Well, you should have probably told me.
I don't just share everything with you.
Well,
I'd have to kind of dribble it out.
Yeah. Well, I'm a little
Otherwise,
slow.
you'll never invite me back.
I'm a little slow, but that's fascinating. So a husband and wife can buy like a joint policy. Is that what you're saying?
There's only one carrier that does it, and it's you have to have the right combination of situations. But yes, so and we have them so that for older people or people who are. You can't be like uninsurable, but if you've got a little bit more health issues than let's say with the average healthy senior, for example, we can use annuities. If you have annuities that have appreciation, and you look at it and say, okay, well that's what I'm going to use to pay for long-term care. Well, okay, but maybe the first half of everything you take out, it would be taxable. We can move that without tax into an annuity version of what I just described, and $100,000 will turn into $200,000 or $300,000 for long-term care. If you don't need it, then the $100,000 plus whatever a modest amount of growth that you have, then that will go to your heirs. So there's a whole variety of ways of doing this. The most important thing, though, is just don't ignore this, because if it happens, it's not pleasant, and the only thing that can kind of mitigate it at all is having sufficient money so you can make decisions that are in the best interest of your spouse or whatever, and not can I afford this?
So again, it's a balance sheet transfer. In that example, you've got a balance sheet, money is sitting in a bank account in your left pocket, you just simply transfer it on the balance sheet to your right pocket. It still shows up. It's $100,000 in the left pocket. It's $100,000 in the right pocket. It's accessible in the left pocket. It's accessible in the right pocket. They guarantee that after a year or two or whatever, you can have all of your money back if you don't like them, and you can learn all about. If you happen to be in the Seattle-Tacoma area, Gene Pastula will be one of my consultant advisors at the SeaTac Airport Hilton on Saturday, April the 25th. Free breakfast. Gene's buying you breakfast too.
Sure.
Call this number, 888-629-1299 if you'd like to show up. AccreditedInvestorSummit.com if you want to sign up. And if you want more information on anything that Mr. Pastula has on his mind, go to his website, SafeMoneyMonitor.com. And be looking in a city near you. Mr. Pastula will be joining us, but we have to wait until after he gets back from his trip to Italy. What is this going to Italy stuff?
I just need a good pizza. That's all.
All right. 844-RAY Show. When we come back, we've got emails. Thank you so much, Gene. We'll talk to you again next time. Gene Pastula, CFP, SafeMoneyMonitor.com.